So as sir rightly said, I've had the opportunity to track both these sectors since long. So I've been tracking IT services in India since last 11 years and financial sector since last 8 years. So both these sectors I have tracked through the up cycle and down cycle. So typically when you have seen both the cycles down and up, you actually get a clear understanding in terms of what this industry can go through. And that's where I've seen it very closely. And then now obviously I'm managing a few strategies here. Now, so let me straight away get to the point that why this slide is there in front of you, Invesco India Financial Services Fund, or for that matter, why financial services. Now, at the start of this calendar year in December, when the entire team at Invesco, so we are close to 10-15 members in the team, including fund managers and research analysts, all the analysts track respective sectors. When we all sat together and we thought that what should be our plan for the next year or CY24, which sectors can do well, this sector had a consensus that financial sector looks very interesting at the start of this calendar year. And the main reason for that was which is the biggest risk in Indian market today. Okay, let me ask you all. What do you all think that which is the biggest risk in Indian market today? Sorry? Election. But how many of you all think that the incumbent government will win through? How many of you all think that Congress will win through? Can I have a raise of hand? How many for Modi? Like, just a guess. It looks like majority, right? So if this happens, do you think Indian market will not do well, or they will not like it, or is it that they don't expect this outcome? Okay, which is the other risk that Indian market has today? So election, while obviously it's a monitorable, but as things stand today, it looks like whatever the market is thinking, on ground also, similar activity is expected. Now, I think from FII's perspective, they are not on ground in India. So they may have this view that what is it there, they may want to check what are the polls, what is the survey saying. But here when we see around, this looks like clearly it is tilting there. Obviously it's not certain till it is done, but it looks like it is okay. Any other risk that comes to your mind? Sorry?
Geopolitical or interest rate.
Geopolitical interest rate, good point. If I am investing my money today, what is the biggest worry that I have? If you are investing your money in the markets today, what is the biggest risk that you have?
Valuation.
Market has already run up so much.
Valuation.
Are the markets overheated? Are the valuations too high? Am I buying at the top? Markets to itna chal gaya. I'm sure when you speak to your clients, do you get that pushback, or do you get, right? Correct. So then if I show you something like this, so which means that this is the biggest risk at top. When we speak to a lot of investors, this is the biggest risk or biggest thought in their mind. Yaar, bahut chal gaya, valuations are too high, what if it corrects? Am I late? I'll wait for some correction, right? So then this sector comes forward in terms of valuations. So if you look at this, so this chart talks about price to earnings of private banks versus the Sensex. So historically, private banks multiple has been trading in line with the Sensex. But today, it is available at 20% discount to Sensex. So what investors want? They want some correction. Right? Everyone says, thoda market gir jayega, then I will invest. Thoda wait karte correction ke liye, yaar already chal gaya itna. But this segment, private banks, this I've used as an example. Private banks are trading at 20% discount to the broader Sensex on price to earnings. अगर आप price to book देखो तो वहां पे भी 19% डिस्काउंट है. So if it is trading at a discount, maybe their earnings are not growing, or there is some challenge, right? So we'll address whatever the challenges are later, but let me first talk about the core, which is the earnings part. If you see, the private bank's profit share in total Sensex profit share is only going up, which means in 23, private banks contributed 7.5% of total profits of Sensex. That is only going up. And if you see the chart also, there was this one dip in COVID, second dip in wave 2, but apart from that, the number is only going up. So profit share तो बढ़ रहा है, but तो भी discount पे है. If you look at the profit CAGR, historically, private banks have either matched or have grown faster than the Sensex profits. This is a 5-year spat, same. 13-year spat, private banks have grown faster. Even the outlook, this is the consensus earnings, even the outlook says that the profit growth is going to be faster than or higher than the Sensex. So earnings contribution is decent. Now you will tell me that you have taken only private banks. Your fund, your fund doesn't only invest in private banks, financial services. So if you look at the broader Nifty Financial Services Index, that is also trading at a discount to Nifty. In this index, it's mainly dominated by banks and NBFCs. So this is the valuation comfort that you have in financial services as a whole. So that's the margin of safety, which is where we like this sector as such. Now let's understand the risks. Generally, what can go wrong in lending institutions? It is easy to lend money, but it is very difficult to recover it back. So which means that your underwriting capability or your decision of whom to lend should be rock solid. Only then your business will do well. Any other business, for example, in your business, what you want is growth. There is no worry of money coming back or not. It's the returns. But ultimately, returns will be again juxtaposed to the market. But there is no capital at risk as such. But for lenders, there is capital at risk, which is where the most important thing for these businesses is that their NPA should be under control, or they should lend to the right people. Only when their NPAs are under control, their tendency to lend more will go up. Only if I am getting my money back, I can lend more. But if I am not getting my money back only, then my tendency to lend will also go down, which means my growth will also suffer. So this is one unique thing about this sector, that your asset quality is the main. If I have to think about various indicators, this is the main indicator which decides the health of the lending sector. And financial sector is dominated by lenders in the form of banks, NBFCs. So which means where are we in this NPA cycle? So this data I have taken back as 1997. And even while I did not get that data from RBI, but what I've seen in articles and all that, even if I go back to 1991, which is the economic liberalization when it happened in India. So that was the time where actually NPAs, where we were suffering, and then eventually there was this liberalization and many of the direct financial institutions gave way to private institutions. Private banks concept came in, there were new regulations for that. They started lending. And when they were lending, this NPA started going up. So in 1997, NPAs went as high as 8%. And the trigger for that was like, in 1997 was the Asian financial crisis. We had our internal problems also in India, and that is where NPAs were very high, 8%. And that was the time where growth also faltered. And that was a bad time for lenders. And then it took almost 6-7 years for this NPAs to come down. In 2004, the NPAs were closer to 2%. And when these NPAs were under control, that was the time where again the credit cycle boomed. The growth in the economy picked up. Now many of us, or at least we have heard, that 2004 to 2010 was a strong bull cycle. One of the drivers was the banking sector or the lending sector or the credit sector. There NPAs were low, and then it remained low for what, next 6-7 years again. And in this period, generally when NPAs are low, when you are doing well, your tendency to grow also goes up, as I told you. And then that also leads to a reckless lending. You started lending very aggressively, you took undue risk. And that was when like power sector, metals and mining, all those sectors saw inflow in the form of loans, but their projects were far out in time, and ultimately what happened was that NPAs went up. So in 2014, when RBI Governor Raghuram Rajan, he said that there are problems in the lending sector, in lenders, and the lenders should actually recognize NPAs upfront. And that was the time where NPAs actually started going up. And now again, where we are in FY23 and even FY24, the numbers will be out in some few days. We are closer to 1%. So how many years did it take? It took almost 10 years for NPAs to be recognized and again come back to a very comfortable level of 1%. In 2021, COVID happened. That was the time where the economy almost stopped. Around 40% of the loan book was under moratorium for many of the banks, which means 40% of people were not paying because their income has stopped. Despite that, the NPAs kept on going down. What does that tell you? For me, it tells me this is the power of cycle. That because you were already into this NPA recognition cycle for last 7-8 years, you had already recognized a lot of pain in the system. And that cycle, even COVID couldn't derail. And that is where the NPAs just continue to go down. So there are two takeaways in this long discussion that I had on this one slide. Two takeaways. One is that the credit cycle is quite long. Right? Last 30 years tells us that. And second, we are at the start of a strong credit cycle. Or maybe we are at 1 year or 2 years into a strong credit cycle. So those are the two takeaways. Which means that for the next, again going back by history, I don't know what will happen in the future, but I know what has happened in the past. Past data tells me, past cycles tells me that we are at the start of a strong credit cycle, or we are 2 years into the strong credit cycle, and this cycle can be as long as 5-7 years based on history. And that is what gives me confidence about the lending sector. Now, if you look at this growth, the point that I made, that NPAs are the main driver for this sector. Where NPAs are under control, everything works well. If you see in 2004, when NPAs were low, okay, 1997, remember the NPAs were very high, 8%. The loan growth was 10%. It was struggling here. In 2004, NPAs became low and then the growth picked up. It went to as high as 25 and 30% in few of the years. Even in 2008 and all, this number was higher than the last cycle. This cycle, the NPAs again went up, and you see the growth actually came down. Now again, here you are already seeing initial green shoots in terms of growth surprising on the upside. You can see this number going up. Let me also tell you, this is a 16% growth, and in March FY24, which is which has just ended, the number is trending at 16%, versus the estimate that the street had was around 12 to 14%. So we are already doing better than what we expected. Now again, I don't know what will happen in the future, but going by the past trend, in a positive cycle, there is scope for positive surprise, and that is already being seen also. So this tells you that when NPAs are under control, growth can surprise on the positive side. So this is my second argument. First argument was margin of safety, valuation, comfort. Second, I am in a strong credit cycle. Now my last argument for financial services is as follows. Now one can argue that credit growth is at 16% and street is believing 14% or 12 to 14%. So next year credit growth, even if it doesn't grow 12 to 14, it can come down by 15 or it will remain at 16. But that's just a 16% number, 16% growth. There are many segments in the market which are growing much faster. And that is another reason why perhaps the mid and small cap or many of the other sectors are trading at a premium valuation. So it's always relative, right? We always compare ourselves to someone else. While if I'm returning 15% return, it's on an absolute basis it is good. But if someone else is doing 25%, then I'm not good. So maybe that, and which is the fact, many other sectors like be it hospitals, be it EMS or a few other sectors or defense, they are growing at a much higher rate. And then if I buy financial services, I don't get high growth, right? That's the pushback, that 16% credit growth. What about high growth? Historically, we didn't have an answer to that because it was dominated by lenders, where the credit growth was limited. But today, if you're following the markets, there are a lot of new listings in this financial services space. This space has expanded meaningfully. New age businesses, Paytm, PB, Fintech, this come under financial services. You have small finance banks, the new licenses that have been given by the regulator just to drive growth. By very nature, these are high growth entities. You have many other specialized microfinance companies. Then you have non-lending financial or non-lending NBFCs in the form of asset managers, in the form of brokers, in the form of life insurance, general insurance. Then you have exchanges, then you have capital marketplace. So this space or this segment did not exist few years back. When I was managing this fund 3-4 years back, this number used to be just 10% of my portfolio. Today it is close to 30% weight in my fund, just because the space has expanded. And all of these qualify under high growth because they are not linked to the credit growth in the country. They have their own growth trajectory. You are into this financial services business. If the SIP book has expanded from 10,000 crores few years back to today 19,000 crores. You yourselves must be seeing the tendency of investors to invest in mutual funds has gone up. The awareness is going up. And all of this segment, all of these sub-sectors qualify being under financial services. So which means that I can also participate into high growth opportunities within the financial services sector. And obviously, this is the India stack. All of us are aware. Thanks to your Aadhaar, that account opening has become so feasible. Thanks to this payments layer, that UPI payment can be done at the click of a button, right? And you have many other such government or public utilities or sponsored by government, something like DigiLocker. Then you have account aggregator. Account aggregators, you can pull the data, you can pull a bank statement of any customer by just asking for a consent. So if tomorrow you want a loan, and if I am a bank, I will just take your consent that say, okay, yeah, I will go to the account aggregator, that I will say I want XYZ's bank statement and all other details, KYC details and all that. And I just have to, account aggregator will take a consent from him, and he says okay, because he wants a loan, he will say okay, and I will get all the bank statement details to me. So that's the power that this technology brings to this country, and and this is leading to many of the so this is the underlying bedrock what is leading to this high growth in many of these financial services sectors. This is an example of UPI. This just tells you that's the potential that India has. That what if you have the right product, if you have the right digital infrastructure, then there is no limit to which that product can grow in India. That's the power that India brings. Today, why Sensex is trading at a premium valuations? One is that growth, we are still the fastest, we have now actually become the fastest growing economy in the world. And it's not that we have accelerated meaningfully. While we have accelerated closer to 6%, but the worldwide there is some slowdown. So this is just tells you the potential that India has. So the point that I want to drive is, this is the inherent strength that the country has. If you have the right infrastructure, right product, then growth is an outcome. So UPI is one example, but I as a financial services fund manager cannot participate in this. UPI is driven by government, it is free. But there are other segments also which are growing at a very rapid pace thanks to digital infrastructure. For example, the Demat accounts in the country in the last 3 years have gone up more than 3 times. Thanks to all these online brokers, they can do, earlier you had to take 15 signatures on the form with all cross marked. It was a pain. Today you don't have to do that. I just go on my mobile, I go to one of these websites, I put in my Aadhaar number, I put in my phone number, I get OTP, I do my Demat account is open, I get the form on my email address. So this is the form, my name, my details, my account number, my Demat, everything is ready. Click of a button. That is while we all of us belong to the same industry, we have done our due, we have done our job in terms of spreading awareness, in terms of financialization of savings, in terms of investing in equity. But at the same time, the digital infrastructure has made it possible that this kind of a rapid growth can happen in the country. And this is an example of Demat accounts. Unique MF investors have doubled. NSE active clients have gone up more than 3 times. And even the F&O and equity market investing has also gone up so much. This is an example where share of discount brokers has gone up from 17% to 60% thanks to technology, right? Technology has made the businesses viable to offer trading at a low rate. When earlier Zerodha was a pioneer here in discount broking, he started with 20 rupees per trade. Everyone used to wonder how will they make money. But today they are they've got the highest profit in this in broking segment. This is another example, right digital infrastructure, right product, right price, volumes will take care. Now all these things, the financial services, the listing, the public markets can participate. This is another SIP contribution, as I just said, 8,000 few years back, it's now 19,000. This was something which we all of us have been always advocating, that kuch bhi ho jaye, don't break your SIP. So SIP is not breaking, thanks to markets also, markets doing well, but at the same time there is massive onboarding of new customers, which we just saw in the previous slide. So all these segments give me an opportunity to participate in high growth segments. So which means that this sector today offers me a unique combination where it is giving me margin of safety in terms of attractive valuations, strong cyclical tailwinds that the economy is in the right cycle or the sector is in the right cycle, and I also get to participate in high growth opportunities. So if you look at our fund, the way our fund is positioned, 39% private sector banks, another 12% PSU banks. So if you combine the two, 50% of the portfolio is invested into banks, where you have a reasonable growth, strong credit cycle, and very attractive valuations. The 30% is invested into non-lending financial services, which participates into high growth segment. And the remaining 16% is into NBFCs, which generally come under growth at reasonable price. And NBFCs, typically we are always focused towards having quality NBFCs, because NBFCs, the regulations are not so easy. Basically, now what we are seeing in the market also, where RBI has become very aggressive in terms of how he wants to, because earlier NBFCs were not under RBI. After IL&FS crisis, NBFCs are now being regulated by RBI. And that's where RBI is doing now audits. First time they are coming under that audit. So that is some kind of a new thing which these NBFCs are going through, and which is where we are more focused towards quality here. So that's my presentation on financial services. That's why we like financial services. 3 reasons, keep it simple. Margin of safety in terms of valuations, strong credit cycle, and high growth secular opportunities in the market. Which is where I'm coming back to where I started, that when we all sat together in Invesco, all our research analysts, this is where this fund came out as a consensus among all of us, that this should do well for investors, and that's why we are pitching this fund as well. Before that, this is a thematic fund, right? Generally, thematic funds are risky by its very thought process. But how is this different? This is different because, first of all, as Anup sir said at the start, it's a large portion of the index. So which means it's not like a 10-15%, it's a 30-35%, or some indexes 40% of the index. So it's broad in that sense. And within that also, the opportunities have expanded so much that within that also we have now got a lot of ideas where we can actually play through, and we can offer that diversification. And on top of that, in a market where valuation is a concern, here you are having margin of safety. So intuitively, it is a risky thing, a thematic fund, but at this point in time, this actually is a well balanced risk reward strategy in that sense. And typically in a thematic fund, we advise to go lump sum, and which is where this is not somewhere where you can go in the SIP format, because valuations on your side. Lump sum is a right recommendation for this product. And then people also want to say that, but kitne time ke liye invest karu? So again, think of that credit cycle. You are just 2 years into the cycle. Historically, to cycles bade hue hai. So 3 to 5 years is a decent time to stay invested into this product. That's where you can kind of advise your investors how to think about this product. So this is one, and second is the another strategy which I manage is a focused fund and large cap fund. Large cap fund is also, as I said, mid and small cap is something where people can go slow. A large cap is something where people can, because large cap is still okay, and that is where some people can go SIP format, or if someone wants to invest, then large cap can also be invested. And another scheme that I manage is a focus fund, Focus 20 fund. I'll give you in short what do we do there. So we buy only 20 stocks there, and that is in lieu of a PMS. So typically what happens is people like PMS. People don't like 60-70 stocks in a fund. यार तू मुझे fund छोड़ यार, give me stock ideas. मुझे तू 2-4 idea दे यार stock का. तुम लोग mutual fund don't tell me 50-60 funds. I don't want. I'm okay. नीचे जाएगा stock. I'm okay. Do you hear this request from people? We hear. So a focus fund is designed in a format that you take concentrated bets, right? We buy only 20 stocks. By regulation, we are allowed to buy till 30 stocks, but as on today, we are buying only 20 stocks, and we are playing concentrated. Then the question comes is then, sir, how do you manage diversification? How do you manage risk? So there are 3 or 4 ways in which we manage risk. One is we at least keep large cap exposure between 50 to 60% in this fund. One. Second, we play various themes through the best vehicle. So for example, we choose which themes we want to participate. Today this fund is participating in defense, which is a high growth theme. It is participating in capital markets, which is another high growth theme. It is participating in hospitals, which is another high growth theme. It was also participating into financial inclusion, where you get one or two banks. So what we do is we diversify across themes so that if capital market slows down, at least my hospitals will continue. If there's some regulatory risk on hospitals that the pricing has to be curbed, then that segment slows down, but at least I don't have a very large weight in only one theme. So that's where we participate in various themes, and within that theme, we buy the best vehicle. So if I want to play hospitals, then I choose the best hospital today in the listed space. And then I invest 5%, 6% in that hospital. I don't want to buy 3, 4, 5 hospitals. That's what some people say, right? तुम मेरे को इतने सारे stock मत बोल यार. Give me 1, 2 stocks. So we buy the best hospital in hospital space. We buy the best capital markets. We buy best 1, 2 or 3 names within capital markets. Banks, buy the best bank that you think is today. So that's a second way of risk mitigation. First was large cap, 50 to 60%. Second was multiple themes. Third was a good mix of growth and value. So that ऐसा नहीं है कि हम लोग सब कुछ मतलब if some growth slows down and some turnaround happens, we don't participate there. So we also have a good mix of growth and value. And last is bottom up, strong bottom up thought process there. We have a very strong research focused. In fact, in our organization, we are completely process oriented. And so much so that a fund manager, even if he thinks like buying something, he cannot buy unless the analyst has done his due diligence and is presented before the IC committee or the investment committee or the entire team. So if I as a fund manager like a stock, I just cannot go to the office and put a buy order. I have to tell my research analyst will take his time, he will do his due diligence, he will make his research presentation and present to the entire team. We'll have debates, discussions, and then the entire team will decide whether that name can be categorized or whether that name can be bought by any of the fund managers. If the analyst shows a red flag, then fund manager, मुझे कितना भी अच्छा लगे, I cannot buy. Because fund manager, because we track so many sectors, so many names, हो सकता है कि somewhere we may kind of cut corners and may not do complete due diligence. So when the analyst, because the analyst tracks only one sector or 2 sectors, he's focused. So it has to go through him. So which is where the bottom up stock selection is very important. When I'm buying the vehicle or the best vehicle in that theme, that vehicle's due diligence has been done by the analyst and is giving me the due folder saying that why this is the best entity. If I want to buy a hospital or a defense company, I will choose the best company, best in terms of what? In terms of performance, in terms of various parameters that is important. For example, in what I presented financial services, if I'm choosing a lender, I want a high growth, I want an improving ROA. Those are the 2 main, and a reasonable valuation at least. Right? These 3 indicators, which is the best entity which gets highest marks on these three indicators. That will be the entity which will be chosen for focus fund. So that's our thought process when we think about focus fund. We want to play concentrated. We want to play the best vehicle in a risk by managing risk in the way I've explained you all. Because risk is an important part which a mutual fund manager should always manage. I think this is about the focus fund.